Welcome back to Dave's Market Explorer. As we sit here on Sunday, July 12th, let's take a comprehensive look at what unfolded in the markets over the past week and how it fits into our broader timing framework. This was a week of resilience mixed with notable volatility. The S&P 500 managed to post a weekly gain of over 1%, closing Friday around the 7,575 level. The Nasdaq also finished positive, advancing more than 1%, while the Dow showed more modest movement but still held firm near record territory. Big tech names were the clear leaders once again. Meta Platforms had an outstanding week, jumping nearly 15% at one point after positive analyst notes and internal AI cost structure updates. Nvidia continued to support the indices, and there were signs of broadening participation even as semiconductor and AI-related stocks experienced sharp profit-taking midweek. Oil prices spiked temporarily on geopolitical headlines involving US actions around Iran, which added some intraday pressure, but the overall tape digested these developments and closed the week on a constructive note. Now, let's tie this directly to our proprietary time and timing system. For several weeks we have highlighted a primary correction window running from June through August. We are clearly inside that window now, with the kind of choppy, rotational price action that often defines these periods. Our system also flags a secondary, potentially deeper window extending from August into October. This layered approach has historically given us excellent positioning around consolidation phases before major advances. The technical case supporting these windows is strong. Analysts at Bank of America have been outlining a classic three-wave corrective pattern unfolding in the S&P 500 during the third quarter, warning that any push toward marginal new highs could represent a bull trap within an expanding flat formation. This aligns beautifully with our timing. Seasonally, 2026 being a midterm election year adds further weight. History shows these years tend to deliver the largest average intra-year drawdowns, with the most pronounced weakness typically clustering between August and October. Elliott wave structures, key Fibonacci support zones around recent lows, and momentum indicators all suggest we are in a healthy consolidation phase rather than the beginning of a larger bear market. These technical layers provide solid confirmation for the windows we have been watching. On the macro front, several developments reinforce the setup. Markets are now testing how the new Federal Reserve leadership will handle its inflation framework, which could introduce policy uncertainty through the summer and early fall. Liquidity dynamics, including potential share unlocks from high-profile companies like SpaceX, may add selling pressure during the secondary window. Geopolitical tensions flared briefly this week with oil, reminding us that external shocks can amplify moves within our timing periods. At the same time, the structural drivers remain intact. The AI capital expenditure cycle shows no signs of slowing. Q2 earnings season is shaping up for positive surprises, and broader inflation data continues to trend cooler with easier year-over-year comparisons ahead. This combination creates the classic backdrop for a correction that ultimately sets up a strong rebound. This brings us to one of the most validating developments of the week: Tom Lee of Fundstrat and his recent interviews. His commentary has mirrored our timing thesis with remarkable alignment. On CNBC's Squawk Box earlier in the week, Tom emphasized that July should be a stronger month for stocks, citing compressed valuations and expected earnings beats. He laid out an optimistic year-end target for the S&P 500 in the 8,000 to 8,800 range, based on 2026 earnings estimates around 400 and price-to-earnings multiples that could expand to 20 or even 22 times. However, Tom also delivered the cautionary side that matches our secondary window perfectly. He warned that between August and October the market could experience a period that might feel like a bear market, driven by the very liquidity and policy tests we have highlighted. In subsequent appearances, including discussions around the morning call sheet, he continued to stress that AI remains one of the most important once-in-a-lifetime structural stories in our generation. He pointed to easing inflation pressures in the second half of the year, better financial conditions, and rising earnings estimates as the fuel that will power the market higher once the summer and early fall consolidation runs its course. His P/E compression math since January and upbeat view on second quarter results further reinforce the idea that any weakness in our timing windows should be viewed as a buying opportunity rather than a reason to exit. Putting it all together, our timing system, technical evidence, macro backdrop, and Tom Lee's mirroring statements paint a cohesive picture. The June through August primary window and the August to October secondary window represent a consolidation phase, a necessary breather after the strong run we have seen. This sets the stage for a powerful year-end rally as the market emerges from these windows. Easier inflation trends, resilient corporate earnings, continued AI momentum, and clearing seasonal and policy hurdles should drive the next leg higher. For traders and investors, the playbook is clear: respect the correction windows, defend key support levels, stay nimble through the volatility, and use any meaningful dips to build positions ahead of the year-end advance. Our system has guided us well through these cycles before, and the current alignment gives us high conviction in the roadmap. Thanks for watching Dave's Market Explorer. Stay disciplined, keep the bigger picture in focus, and we will see you in the next update as we navigate these important timing windows together.